New companies are once again storming the stock market. We are seeing initial public offerings in the same amounts as we have seen at the end of the 90s during the dot-com bubble. Even here in Europe, one analyst fearing another bubble, while another one sees new chances. What's up everyone, my name is Joris. Snowflake, Unified Post, Corsair Gaming, Palantir, the list of new IPOs goes on and on. This year alone, more than 100 new companies have found their way into the Nasdaq, America's leading tech index. The companies have collected over $30 billion new capital by going public. This year proves to be the best year for new listings since the dot-com crash 20 years ago. Most of the IPOs are also proving to be very successful, with an average return year-to-date of 42%, according to Florida's University economist Jay Cordell. You, as an investor, are making a change by investing in those tech companies, giving them financial room to expand, to grow, and by destroying the like button for the YouTube algorithm and subscribing to the channel if you've not done that already. But even here in Europe, new companies are finding their way to the public stock market. And even in Belgium, after years of having no initial public offerings whatsoever, there will be 4 new names by the end of 2020. This is a good thing. The stock market has always been a bridge between the money savings of the investors and the financial needs of the companies that go public. They want to grow. But due to low interest rates at the moment and no real alternatives, the amount of money that these IPOs attract is unbelievably high. The price to earnings ratio these companies achieve are crazy high, dizzyingly high, based on speculation and good faith. Some companies are even priced around 1,000 times their expected earnings. Mark Mobius, a famous German-American investor, recently stated that the current craze has a lot in common with the dot-com crash back in the 1990s. But does he have a point? At first sight, we are in the same boat as we were back then. People tend to invest like crazy and they just throw their money to tech companies that have not even made a single dollar in profit yet. Back in the 90s, it took 4 years before the dot-com bubble eventually burst, so I guess there is still a margin in time here. Other analysts, however, note that there are important differences between now and then. At the moment, we have next to no interest rates, so people are definitely in search for a return on their money. Since government bonds and real estate are losing their return and thus their appeal, more and more people are looking at the stock market. More money goes towards the stock market, so there is more money for IPOs of the new companies. It is furthermore very logical that the tech companies' IPOs are so successful. We have seen a crazy rise in the stock prices of tech companies in the last half year, as well as their earnings and profits. Investors understand that the world of tomorrow will be more digital than ever, and they are willing to invest in the next generation of technology companies. During the pandemic, we have seen that the digitalization of the world is coming, and it's faster than ever. People were working from home, they are ordering a lot more online, so it's a logical conclusion that these tech companies will be needed in the future. Another difference with the 90s is that the companies that now kick off their IPOs are often better in quality than they were back then. Back in the 90s, every company that had a website ending in .com, they went public, and investors jumped in like headless chickens because they knew the stock would rise in the first weeks. They didn't even bother to check the company and its books. It was a safe bet. Companies without a lot of earnings and without profit model went public. They rose to the top, supported by unknowing investors. Companies like webfan.com, pets.com, etoys.com, garden.com, and many others .coms went public at the end of the 90s, and they were valued over several million of hundreds of dollars. And not even 2 years later, most of them went bankrupt. The enthusiasm we see nowadays still bears risk. The search for return on capital for the investors will result in higher prices to earnings ratios for already public companies. This results in more risky companies to find their way to the stock market as well. The success of this handful of companies will shine over to the new companies, giving them a ride along the money roller coaster. If the companies that are actually generating good margins are not differentiated from those that are full of air, there will be a major risk. The FANG stocks and the other major tech stocks that are common now are carrying the Nasdaq, with a lot of newer companies surfing along on their waves. The FANGs are putting down great results and great growth numbers, which totally explains their high price to earnings ratios. Other companies are not doing as well, and they should be invested in with real caution. The really good tech companies are very few in number, while other few hundreds of stocks are also valued at the same price to earnings ratio, but they do not have the same potential of growth or numbers to show for it. Very high price to earning ratios, so they are very expensive stocks and they have next to no profits. We do, however, have a great advantage over the 90s now. Back in the day, every single company could go public without any prior investigation by the banks. Nowadays, companies have their accounting well groomed and they have to provide all different kinds of documents and regulations before even being considered to go public. I guess it's still possible for a few to pass through the nets, but it's definitely not as bad as it was in the 90s. Looking at these facts, there is no real bubble in the tech market at the moment. The few companies that actually made the money they claim they are making are definitely priced well. Others might be overvalued, but they will return to the mean soon enough. There's no reason to believe that the market is in the same distress as it was in the 90s. The low interest rates forces people to invest in the stock market, since money is losing value in your bank account, in your savings account. So why should you not invest a part of your savings in the future of the world? And this is what Warren Buffett was thinking as well. Ever since 1956, Buffett has never bought into any IPO. He said often that he doesn't believe in the public offerings, often priced too high. But now, in times where he does not find any good deals, he's even bought his own shares the last few years, which he rarely done before. He now invested $730 million into Snowflake, a cloud-based data warehousing company. A nice investment it proves to be, doubling his initial investment. Of course, this is but paper profit, since Buffett is rarely known to sell any of his investments. It is also very surprising that he now is investing in a tech stock. Two things he swore never to do before. The influence of his new successors is definitely bearing fruits. Initial public offerings are important. They allow companies to create added value and stay put. A lot of companies in biotech and real estate have only been able to achieve what they are doing by going public and by accepting the investors' money. More money to work with can be invested and a larger return can be achieved. It also allows tech companies to buy other tech companies and they can grow instead of being bought themselves. There is always a bigger fish in techland. Prominent CEOs in Europe are hoping that Europe will provide a good framework to support new tech companies so they can grow in Europe and not to be bought out directly by other companies in Asia or in America. It is important to make tech companies in Europe grow to resist the rising markets of America and China. Both markets have very strong tech markets and they support their companies very well. Europe should not stay behind, because if we do, our economy will also fall far behind in the future. There is a lot of incentives in Europe, especially in sustainable energy, technology, water, and so on. The companies in these fields need continental-wide financial support. They need money to grow fast, but unfortunately, most of them are bought out before they reach their full potential. This means that Europe loses all of their profits, their taxes and their royalties. A continent-wide support system could help prevent any of that. And we as investors, we can invest in that future. Now, how should you invest in these times of numerous IPOs? It is important to see that the overall market, the overall global economy is definitely aided by these new companies that are added to the stock market. Technology keeps growing and making evolutions and moving forward so that new companies and new ideas will always be needed. As I said before, these companies also need the possibility to exploit their ideas and they have to gain market share. But you should not invest headfirst in every initial public offering you see. Think of Warren Buffett. He waited over 60 years to invest in his first IPO. Look at the company, look at what they are doing, and then decide if you want to invest in them or not. A lot of people will invest without prior knowledge, bumping up the price, so really beware of overpriced companies. Better not to invest than to invest in companies that are definitely way overpriced. You should know that IPOs are there to generate as much money as possible at that point of time. The company that goes public wants to gain as much as possible, and the helping banks are also there to take their share of the profit. So it's in all those parties' favor to have the price as high as possible. The investor that does not know what he is doing might be paying a very high price. So invest with money that you do not mind losing, since a return on an IPO is often a very risky bet. If you have enjoyed this video, be sure to destroy the like button for the YouTube algorithm and to subscribe to the channel if you've not done that already. It's very easy, you can always unsubscribe later, but it helps me and the channel a lot to grow. I thank you for watching and I will see you in the next video.